Good evening, everyone. Here's your macro wrap-up to end the day with some clarity on what's driving the markets globally. Let's start with the US dollar. It's been a rough session across risk assets, but that's kept the market in defensive mode. Typically, that favors the US dollar, but there's some deeper concerns that are starting to emerge. The focus right now isn't just about liquidity, it's about the health of the US balance of payments. The dollar is under pressure from a 4% current account deficit, and there's rising concern that foreign investors could begin pulling out capital of the US markets, or at very least increase their currency hedging. That doesn't mean there's panic, at least not yet. There's no confirmed sell US assets sentiment taking hold, but we're starting to see some cracks. For example, the US 5-year CDS spread widened by 5 basis points last week. That's a sign of perceived risk. Still, US bonds aren't underperforming German bonds, which is something we'd expect if there was real fear in the markets, but it is worth watching. Especially with this week's Treasury auctions, the US Treasury is set to issue $119 billion in bonds across the 3, 10, and 30-year maturities from Tuesday throughout to Thursday. If these auctions show demand or low bid to cover ratios, that could potentially spook the markets and become a meaningful headwind for the dollar. Shifting to crude oil, we've got a supply and demand story that's losing balance. On the demand side, growth expectations for 2025 have been cut in half, down from 900,000 barrels per day to just 450,000. That brings expected global demand to around 103.4 million barrels per day, with much of that downgrade tied to the impact of tariffs, which are weighing on industrial activity and cyclical in energy demand. On the supply side, OPEC announced a 411,000 barrels per day increase for May, but in reality, the actual increase is likely closer to 170,000 barrels per day, mostly just to adjust for members who have been overproducing anyway. So we're not looking at a full-scale price war yet, but history reminds us that similar moves like in 2015 and 2020 have led to sharp price declines, so it's definitely a space to monitor closely. Next up, let's talk a bit about gold. Gold has been caught in crossfire of today's market volatility. On one hand, you've got strong safe haven demand, and on the other, gold is still a liquid asset, which means it often gets sold off to cover margin during market stress. It's a pattern we've seen before. Gold dips during risk-off shocks, then rebounds when investors reposition. The broader macro backdrop still favors gold. The outlook remains solid, especially with increased risk of recession on the horizon. In fact, over the past 7 US recessions, gold has averaged a 15% annual return. That's not a small number. Looking ahead, the outlook for Q2 has been revised higher. Average gold prices are now expected around $3,300, up from the previous $2,900 forecast. That says a lot about where the sentiment is heading. Overall, we're seeing a fragile balance. Risk aversion is rising, capital flows are shifting, and commodities are reacting to complex mix of macro and geopolitical themes. That's your evening update. Stay sharp, and we'll catch you in the next one.